What's up guys, welcome to the door number 2 of the finance calendar, where we dive into 24 financial ratios in 24 days. Don't forget to subscribe so you don't miss any of the ratios, and let's go! Yesterday we learned what earnings per share is, and I quickly mentioned that it is mostly used with the PE ratio. So what's a better way to continue than to go through the PE ratio today? PE ratio means the price to earnings ratio, and it is simply calculated by dividing the market value of a company's stock by the earnings per share. There are different earnings per shares used for the PE ratio. You can use the trailing 12 months TTM, the EPS from the latest accounting period, or even estimate the future earnings. So basically, for the trailing 12 months, you would use the earnings per share from December 2021 to December 2020, for example. And for the EPS from the latest accounting period, you can look for the company's latest financial report to find out what EPS they are reporting. The current stock price P can be easily found by just checking how much a stock is currently selling for. So let's take a look at a couple of examples. In the last video, we calculated that Apple's 2020 EPS was $3.28. The price of the stock is currently $169.48, so the PE ratio is 51.67. For the trailing 12 months EPS, I am going to use the one from Yahoo Finance, which is 5.61. You could of course calculate this by yourself, but I'd rather take a shortcut and take a look at a couple of different finance websites. They all have 5.62 or 5.61 for the trailing 12 months EPS, so we can assume it's correct. With that, the trailing PE ratio would be 30.21. For the forward PE ratio, you have to estimate the future earnings of the company. This isn't a very easy thing to do, and it requires a lot of studying the company. You can do this by reading things like annual reports, balance sheets, quarterly reports, news, and billions of other things. But after you have deeply studied all the available information, you can come up with the estimated future earnings. Just for example, and just to be clear, this number is pulled out of nowhere, you could end up with the estimation that Apple's 2022 earnings will be $75 billion. Then you divide that number by Apple's 17 billion shares outstanding and get an EPS of 4.41. Now you can calculate the forward PE ratio by dividing the current stock price by the estimated future EPS. But what about companies like Nokia? Their 2020 EPS was minus $0.51, and their TTM EPS is minus $0.3. The price of the stock is $50.66, so the PE ratio is either minus 11.1 or minus 16.4. When the PE ratio is negative, it is usually just shown as not available because a negative PE ratio doesn't provide us with any useful information. So now that we know how to calculate the different PE ratios, let's take a look at how we can use them. First of all, the PE ratio tells us how many years will it take for the stock to pay back the money invested. Let's say that the PE ratio for a company is 15. This means that it will take 15 years for the company to earn the amount of money we have invested if the earnings stay the same. The average PE ratio for S&P 500 is 14.87. If the company has a PE ratio higher than that, let's say 30, it could mean that the company is overvalued. If the PE ratio is less than that, like 10, it could mean that the company is undervalued. This doesn't mean that you should buy all the companies that have lower PE ratios, but instead you should try to figure out why is the PE ratio lower or higher. For example, Tesla's PE ratio is very high, 367.57. This could be because investors believe that in the future Tesla's earnings will increase a lot. You can also use the PE ratio to compare different companies. You should do this for companies that operate in the same industry for more useful information. Let's take Tesla for example. It had a PE ratio of 367.57, which makes it sound very overvalued. But if another electric car company has a PE ratio of 350, Tesla doesn't sound that overvalued anymore. Then again, BMW basically works in the same industry and only has a PE ratio of 5, which makes Tesla sound very overvalued. If we have two banks that operate in Finland and the other one has a PE ratio of 10 while the other one has a PE ratio of 20, it could tell us that the bank A is a better investment. However, you should never make your decisions based on one ratio, because the reason for the higher PE ratio could be the fact that investors think that bank B has the better future earnings. So in short, the higher the PE ratio is, the higher earnings growth investors are expecting from the company in the future. A low PE ratio could mean that the company is undervalued or that the investors are not expecting earnings to grow much in the future. If the earnings are negative, the PE ratio is not available. That's it for today's financial ratio. Hit the like button if you found this video helpful and make sure to subscribe so you don't miss the rest of the financial ratios in the future. Also, if you have any questions, feel free to leave them down in the comments. I'll make sure to answer them. Have a great day and I'll see you tomorrow. Bye!